Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CHENIERE Energy Partners LP quarterly report. CHENIERE Energy Partners LP offers a range of businesses and services including providing liquefied natural gas, LNG, to energy companies, utilities, and trading firms operating the Sabine Pass LNG terminal in Louisiana for natural gas liquefaction, and export managing a natural gas supply pipeline, connecting the terminal with various pipelines exporting LNG internationally. CHENIERE Energy Partners, LP, CQP, has seen a 19.34% increase in its stock price over the past year due to several positive developments. The company reported strong third-quarter results with a 17% year-over-year revenue increase and a 4% rise in adjusted EBITDA. CHENIERE also reaffirmed and raised its full-year 2025 distribution guidance, demonstrating confidence in its financial performance. Additionally, the company achieved significant operational milestones, including producing and loading its 3,000th LNG cargo since beginning export operations at the Sabine Pass LNG terminal. These factors have contributed to the stock's appreciation, despite some mixed performance due to unfavorable changes in derivative instrument valuations. The primary drivers of revenue growth or decline can be attributed to several key factors. On the positive side, higher pricing per MMBTU due to increased Henry Hub pricing contributed significantly to revenue growth, generating an additional $367 million and $1.8 billion in increases. Additionally, LNG revenues net of cost of sales and excluding derivatives also saw increases of $9 million and $37 million. However, on the negative side, lower production volume primarily due to planned large-scale maintenance activities led to a decline in revenue. This resulted in decreases of $18 million and $185 million. Furthermore, volumes loaded and recognized as revenues declined by 3% for the 3 months ended September 30, 2025. These factors highlight the importance of balancing revenue growth with operational efficiency and planning to mitigate potential declines. Net income and profit margins decline due to increased expenses and derivative losses. The company's net income experienced a decline of $187 million, or 9.9%, from 2024 to 2025. This decrease was accompanied by a significant drop in profit margins, with the 3-month margin falling to 21%, down from 31%, and the 9-month margin decreasing to 21.7%, down from 30.2%. The quarterly net income also declined, with a $142 million drop from Cone to Q2 2025, and a further decrease of $86 million from Q2 to Q3 2025. The primary reasons for this decline in net income and profit margins were the unfavorable changes in fair value of derivative instruments, which resulted in losses of $162 million and $190 million. Additionally, the company faced increased operating costs and expenses, leading to a decrease in net income margin. These factors collectively contributed to the decline in net income and profit margins, highlighting the need for the company to reassess its financial strategies and mitigate these losses in future periods. The company is indeed generating positive operating cash flow. According to the financial summary, for both the 9 months ended September 30, 2025 and 2024, net cash provided by operating activities was a significant positive amount, indicating that the company has been consistently generating sufficient cash from its core operations to meet its financial obligations. The company's debt level and interest expenses have undergone significant fluctuations over time. Initially, current debt increased from $351 million to $605 million, page 5. However, total debt decreased from $15,232 million to $14,880 million, page 16, indicating a net reduction in overall debt. Long-term debt also saw an increase of $990,000, from $6,731 to $7,721 on page 33. Regarding interest expenses, there is conflicting information across different pages. However, it appears that interest expenses have generally decreased, with significant decreases reported on pages 30 and 17. The latter page attributes the decrease to a reduction in long-term debt and changes in interest rates. Overall, while the company's debt level has seen some fluctuations, its interest expenses have largely decreased over time. Management's outlook on company strategy. The company is focused on disciplined and accretive growth through long-term commercial contracts that provide credit-accretive returns. A key strategy involves developing the SBL expansion project, which aims to increase peak production capacity to approximately 20 MTPA of LNG by 2026/2027. The goal is to secure 90% of liquefaction capacity under long-term agreements with creditworthy counterparties, ensuring a stable and profitable future for the company. Concerns about inventory buildup and supply chain disruption exist. A review of the financial summary reveals that there are indeed concerns regarding inventory buildup in the company's operations. Specifically, a statement on page 11 explicitly notes inventory buildup, yes, indicating a potential issue with excess stock levels. This raises questions about the impact on supply chain efficiency and overall business performance. That concludes the financial summary for CHENIERE Energy Partners LP. Feel free to comment below, and I will be happy to answer them when possible.